Kevin Warsh takes over the Federal Reserve. Why Nigeria and Africa should pay attention. His policies will affect our currency and debt. We must prepare to protect our interests. Good evening. Tonight, we focus on one appointment that may quietly shape the direction of the global economy over the next 4 years. From inflation and interest in the States to exchange rate pressures in Nigeria. Kevin Warsh has officially been sworn in as chairman of the United States Federal Reserve, succeeding Jerome Powell at what many analysts consider one of the most consequential known economies since the post-pandemic recovery. A question now is simple. Will Warsh steer the global economy towards stability or preside over a period of deeper financial volatility? Why does this matter globally? One must first understand the power of the Federal Reserve. The U.S. Federal Reserve is not merely America's central bank. It is effectively the anchor institution of the global financial system. Its decisions influence global borrowing costs, foreign portfolio investment, commodity prices, bond markets, emerging market currencies, and ultimately inflation across developing economies. In practical terms, when the Fed changes the direction, global markets reprice risk almost immediately. And for countries, Nigeria, that matters significantly historically. Federal Reserve chairmen tend to inherit moments of economic stress. The past chairmen include but not limited to Paul Volcker 1979-1987, a legendary inflation fighter, raised interest rates to nearly 20%, crushing double-digit inflation and restoring Fed credibility. He was later praised for laying the foundation for decades of stable growth. His administration triggered a painful recession. From 1987 to 2006, the Great Moderation oversaw a long economic expansion with low inflation and stable growth. It successfully navigated the 1987 stock crash, the Asian financial crisis, and it was criticized afterward. Let's talk about Ben Bernanke, who led the Fed from 2006 to 2014. Critics say his low interest rates helped fuel the housing bubble before the 2008 crisis. He later introduced quantitative easing to respond to the crash. Let's talk about Ben Bernanke, who led the Fed from 2006 to 2014. Critics say his low interest rates helped fuel the housing bubble before the 2008 crisis. He later introduced quantitative easing. The Federal Reserve introduced QE to rescue banks, an extraordinary liquidity measure. Bernanke was criticized for bailouts and controversial money printing policies. Janet Yellen from 2014 to 2018 was the first female Fed chair. She oversaw steady labor market recovery and gradual normalization of interest rates after the financial crisis. Faced concerns over slow wage growth and low inflation persistence. I am Jerome Powell, Federal Reserve Chair from 2018 to 2026. We managed the COVID-19 economic shock, launching emergency market interventions. Later, we aggressively fought post-pandemic inflation with sharp interest rate increases. Jerome Powell managed the COVID-19 economic shock. He launched emergency market interventions. He then fought inflation with sharp rate hikes. He faced criticism for calling inflation transitory. Kevin Warsh, 22 May 2026, is the newly sworn-in Fed Chair. He will pursue a reform-oriented Fed focusing on inflation control and institutional independence. Immediate tests include rising oil prices and geopolitical samira, elevated geopolitical tensions, stubborn inflationary risks, rising oil prices, and increasing political scrutiny over central bank independence. Warsh's immediate challenge lies in one fundamental: to hold interest rates steady or tighten policy further. If inflation persists, this balancing act has become increasingly difficult. Oil prices have climbed sharply following heightened Middle East tensions, particularly involving Iran and Israel. Mortgage rates in the United States reached their highest levels in months. Consumer spending continues to support growth, despite affordability concerns. This creates a highly complex environment for monetary policy. Cut rates too soon, and inflation may accelerate. Keep rates elevated for total and growth making materially for Nigeria and Africa in economics. The implications are immediate and consequential should the U.S. maintain a higher interest rate environment. The U.S. dollar is likely to strengthen further. Historically, stronger U.S. yields attract capital away from emerging markets. Moving into safer American assets for Nigeria could mean renewed pressure on the naira, weaker foreign portfolio inflows, tighter liquidity conditions, and rising debt servicing costs, particularly for dollar-denominated obligations. At the same time, elevated oil prices could offer temporary fiscal relief to oil-exporting economies such as Nigeria through stronger export earnings. In essence, Nigeria may face a dual reality: higher oil revenues on the one hand, but tighter global financial conditions. On the other hand, managing that balance will become increasingly important for political makers. Ultimately, Kevin Warsh may serve as chairman of America's Federal Reserve, but his decision will extend far beyond Washington, because in today's interconnected economy, a policy decision in the United States can influence inflation in Lagos, borrowing costs in Nairobi, and investment sentiment across Africa. This is not simply an American economic story, it is a global one, and Africa will be watching closely.